Welcome to EDS, and in this video we're going to take a look at how you can write your own options contracts, how you can collect a premium upfront and generate a consistent return year on year. So the first thing we're going to do is pull up our brokerage platform. We're using tastytrade and we're going to be writing options contracts. So we need to see where we are in the options cycle. So if you go over to the trade tab and you just want to pull up a options chain just for any underlying, as we can see here, we've got our weeklies and our monthly expirations. Our next expiration is September 20th. This is a monthly. It's 1 day away, which is far too close for us. So we're going to go to the next monthly expiration, October 18th, which is 29 days away. 29 days is a little bit on the low side. We like to be anywhere between 30 and 60 days. So you could even go for the November 15th. That wouldn't be wrong. But we're just going to go with the October 18th for today. And what this tells us is we're going to be in this position for potentially up to 29 days, even longer than that, potentially. But as a general guidepost, 29 days is what we're looking at, right? So what we want to do is we then want to open up our watch list. This can be your own watch list, a pre-made watch list. It doesn't matter. And then what you want to do is click on this little filter and you want to filter out everything that has earnings between now and the next 29 days. And what you'll be left with is everything that does not have earnings over the next 29 days. And the reason why this is important is because we do not want earnings to disturb our positions. It can mess with your deltas. It can increase volatility, and all of these things will have a negative effect on your P&L. So we've removed earnings. Next, what we want to do is make sure everything has a 3 or 4 star liquidity level. So again, in the filter section, you can make sure only 3 and 4 star level liquidity underlyings are in the list. Now we want to order everything from a high IV rank to a low IV rank, and this is because we want to short volatility, we want to play the contraction, and we want to sell when volatility is high, and then of course buy back when volatility is low. So we start off at the top end. We've got the Australian dollar futures at the top. We've got the Canadian dollar futures at the top with some very, very high IV ranks. We're not going to look at futures today. We are just going to stick with equities. We have got Intel here with an IV rank of 72.8. Earnings is just after our expiration, October 24th. I suppose we could have a look at Intel. We just actually closed a position on Intel yesterday for some nice profit. For anyone that has been following along, we had a lot more positions open. We've just been closing them off like a conveyor belt. We work the positions, and then when we get a chance to close in a profit, we just take the profit. And we've got 4 positions left that we're working. We are going to look to open some new positions soon. So let's just take a look at Intel. I mean, we've got BA as well. We have got SMH and AMD already in our portfolio. You want to make sure you are nicely diversified. You're not going too heavy in any one sector or anything like that. So I guess we could just keep going down the list a little bit until we get to, say, Google. That's actually the IV rank of Google is 27. That's a bit too low. So this is what it looks like when you're trying to find a position. By all means, you can open up different watch lists as well. We've got Beyond Meat that's trading at $6. $6 is a little bit too small for us. By all means, you can still trade it, but it's not the best. GM, General Motors, with an IV rank of 57.6. It has got earnings on October 22nd. 4 days after our expiration. I guess we could take a look at GM. Straight away, there does seem to be some skew here, but that's okay. We could just take a look at GM and see what we come out with. So first thing we want to do is look at the skew, right? Not the skew, sorry, the spread. As we can see here, we're 3 cents wide. 2 cents wide, 2 cents wide, 2 cents wide. So nice and tight spread, which is good to see. Next, what we want to do is have a look at our deltas. We typically like to be um, anywhere between 16 and 20 deltas for GM, because we have got a limited selection of strikes to choose from. We are going to be forced to go either higher or lower on the call side. There's only a 12 delta or a 26 delta. So let's have a look at the put side first. We've got a 16 delta on the put side, which is at the 45 strike. So if we come over to the call side, let's have a look. What can we sell? The 12 would be a little bit. The 12 delta would be a little bit bare. I think we'll go with the 26 delta at 52.5. So we've got the 52.5 and the 45 strikes. We'd be selling both of these contracts. We'd be selling the call and selling the put. And by doing this, what is happening? Okay, so if we mark this on a chart so you can visually see what it looks like. So 45 and 52.5. So 45 and 52.5. So about there is the range that we've created for ourselves. This is our put contract and this is our call contract. And this is the range that we've created for ourselves, and we want the price to stay within this range. If price is within this range at expiration, which is 29 days away, then we will keep 100% of the premium. Okay, and what is the premium? The premium is this. We collect this up front. As soon as the order gets filled, this gets added to our cash balance. So we'd collect $1.07 of premium up front. There's 100 shares per contract, so that'd be $107 in premium up front. Our broker is going to require just under $700 in buying power, which is not a bad return on capital considering this is a strangle or a naked position. So we collect $100, we tie up $700, and we've got a 68% chance of profit, right? 68% chance of price being within this range at expiration, and there's an 83% chance of hitting 50% of max profit at some point between now and the next 29 days. So you're looking at between 70 and 85% for your probability of success, right? So this is a very, very high probability trade. Because this is quite a small position in itself, we don't really need to look too much about what to do if you have a small account. Typically, if you have got a smaller account, you can just buy another contract that is a little bit further out. However, I wouldn't actually recommend doing that for this position. It would make things a little bit too bare. There wouldn't be enough meat on the bone, and it only requires $700 in buying power anyway, so I don't think it's a requirement. But there you go. That's how you can find positions and how you can, put positions on. And if this is a position that you wanted to put on, you just send the order and see if you can get filled. This is what our portfolio looks like at the moment. There is something else you need to keep in mind when you are looking for positions. It is your sizing, your position sizing. We have got a position sizing template that's for free. Anybody can get access to this for free. The link is in the description. Just click on the free position sizing template. And the way it works is you enter in the size of your portfolio. Let's say if it's $19,000, and then you enter in what the current VIX level is. Let's say if it's 16.3. Everything below will then be automatically calculated for you. And you simply just need to use this to form the backbone of your portfolio. Use it as a guidepost, and you'll do just fine long term. If you do want to see what positions we're placing, and if you want to copy our trades and make money along with us, then click the link in the description. Head over to EDS Premium, get yourself signed up. And what you will get inside EDS Premium is access to all of our portfolios. So doesn't matter what size your account is, we've got small and large portfolios. There'll always be a position for you to copy. There is also a full course, so no prior knowledge is required. You can learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money-back guarantee. So if you've studied our full course and followed all of our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. And right now it's £1 a month. The price will be increasing. However, once you're in, you're locked in at that price. You won't need to worry about future price increases. And with that being said, I will see you guys on the inside.